Hey everyone, let's just dive right in. Today, we're looking at a truly incredible turnaround story that's unfolding in the semiconductor equipment space right now. We're talking about Ichor Holdings. If you follow the space, you know they design, engineer, and manufacture these absolutely critical fluid delivery subsystems for semiconductor capital equipment. Now, the semi industry is notoriously cyclical, right? But what happens when a company doesn't just, survive a trough, but actively repositions itself to absolutely dominate the incoming wave? Well, in today's explainer, we're going to break down exactly how Ichor is catching what many are calling a massive industry supercycle, shifting their global footprint and structurally transforming their entire business model to maximize profitability. All right, here's a quick look at our roadmap for today's explainer. First, the Q1 revenue rebound. 2, super cycle drivers. 3, shifting the footprint. 4, their product evolution. 5, a $200 million war chest. And lastly, outlook and morale. Okay, part 1, the Q1 revenue rebound, beating expectations. So the numbers are actually telling a really fascinating story here. For the first quarter of 2026, Ichor posted $256.1 million in revenue. Now, why does that matter? Well, it actually beat the midpoint of the guidance range they gave investors back in February. It's a huge signal that the momentum they were hinting at last year might be materializing a lot faster than anyone expected. When we compare that to the previous quarter, Q4 of 2025, which sat at $223.6 million, we're looking at a massive 15% sequential jump. Management basically confirms that Q4 was the absolute bottom of the cycle, and they're viewing this rebound as the start of a sustained long-term upcycle. But, we really need to look under the hood at profitability to get the full picture. On a GAAP basis, sure, they reported a $2.5 million net loss. But when you strip out the noise, things like restructuring, shutting down older facilities, and stock-based comp, the non-GAAP operational truth of the quarter really shines through. We're talking a non-GAAP net income of $5.3 million and a gross margin of 12.8%. If you're analyzing a turnaround, this is absolutely crucial. It proves they are generating real operational profit while simultaneously funding a massive internal transformation. Moving on to part 2, drivers of the supercycle, riding the wave. Let's talk about WFE, or wafer fabrication equipment. For those who track the space, you know this is the total capital spend for building semiconductor fab plants. When demand for super complex chips, like the ones driving AI, advanced logic, and high bandwidth memory, goes through the roof, WFE spending skyrockets right along with it. And since Ichor provides the critical fluid and gas delivery systems that literally go inside this equipment, when WFE spending rises, Ichor's addressable market just naturally expands with it. But here's the kicker, right? It's not just about making more chips. It is all about the complexity. We are now heading into what's known as the angstrom era. We're talking about next-generation semiconductor tech where features are measured at 1/10 of a nanometer. At that microscopic level, material is being added or removed quite literally one molecule at a time. That requires an unprecedented level of precision in etch and deposition processes. And wouldn't you know it, that happens to be the exact segment of the market where Ichor's fluid and gas delivery systems are heavily utilized. And the sheer pace of this shift, it's kind of staggering. Ichor's CEO, Phil Barrows, actually put it perfectly on their recent earnings call. He said every week we get an updated forecast, and every week we're seeing strengthening demand. I mean, this isn't some slow, gradual recovery. This is rapidly building demand driven by fundamental technology transitions and global capacity additions. Which brings us to part 3, shifting the global footprint, built for margin. To actually handle all this demand, Ichor is pulling off a massive global realignment. They're finishing up a huge machining expansion down in Mexico, and they've just launched a brand new manufacturing center in Malaysia. That Malaysia facility, by the way, is the largest in the company's entire history. Now, moving all these machining assets to high-volume sites obviously creates some short-term headaches and capacity headwinds, which they had to absorb in the first half of the year. But structurally speaking, it totally eliminates the rent and margin challenges they dealt with in 2025. They are setting themselves up for massive long-term leverage. And honestly, here is the big payoff for all that heavy lifting. Starting in the second quarter, management expects gross profit dollars to grow at basically twice the rate of revenues. Because they're now leveraging these new, hyper-efficient facilities, every new dollar of revenue that comes in is significantly more profitable than the last one. All right, part 4, evolving into a product company, the 2026 milestone. So, historically, Ichor was what you'd call an integration company. Basically, they assembled components that other people made. But they are aggressively pivoting away from that into a true product company model. By the end of 2026, their goal is to have Ichor branded proprietary products supporting up to 75% of the content within the systems they sell. Going from just assembling other people's parts to actually selling your own proprietary tech, that is the ultimate game changer for unlocking those high gross margins. Oh, and here is a totally unexpected twist. Their CEO recently dropped this little nugget. Our fifth largest customer is now outside the semiconductor industry. Wait, what? Yeah, through some really strategic design wins, they're actually seeing revenue growth in the commercial space sector. This kind of diversification is huge. It proves the versatility of their engineering and opens up an entirely new growth avenue that could actually outpace the traditional semi business this year. Let's look at part 5, raising a $200 million war chest to capitalize on the future. So Ichor recently set up a sales agreement to offer up to $200 million in ordinary shares. Now you're probably wondering, with revenues bouncing back and margins expanding, why dilute and raise $200 million right now? Well, it's really all about fortifying that balance sheet so they can go on the offensive. First up, they plan to use the net proceeds to just wipe out their outstanding term loan, which is sitting at over $115 million. Getting rid of that debt slashes their interest expenses, which have been running about $1.7 million a quarter. The rest of that capital, it acts as a literal war chest for potential acquisitions and strategic growth. When you're entering a super cycle, you absolutely want dry powder ready to deploy, and this raise gives them exactly that. Finally, part 6, outlook and employee morale. Let's check the pulse. The financial outlook here is honestly pretty aggressive. After hitting $256 million in Q1, they are guiding for Q2 revenues to land somewhere between $290 and $310 million. If they just hit the midpoint of $300 million, that is another massive sequential leap. They are flat out telling the market that the demand is real, it's accelerating, and most importantly, they have the actual capacity to deliver on it. But let's look beyond the spreadsheets for a second and check in on the human element. According to the alt-date provider Alt Index, Ichor's employee outlook score is currently sitting at 51 out of 100. While that might sound pretty middle of the road, it's the trend that really matters here. That score is actually up 6.3% month over month. As the company ramps up hiring and these massive new facilities finally come online, internal sentiment is definitely shifting positive. And as we all know, better morale usually leads to better execution, which is going to be make or break during this kind of ramp up. Which leaves us with one final thought to chew on. Ichor Holdings is literally staring down an Angstrom-era supercycle, armed with a newly optimized global footprint, a high-margin proprietary product strategy, and a completely refreshed balance sheet. All the pieces are on the board. So the only question left is, as the semiconductor industry rockets into unprecedented territory, can Ichor's operational execution actually match this soaring demand? It's going to be a fascinating story to watch unfold. Thanks so much for joining me for this explainer, and keep learning.